get the disclaimer out of the way, and hopefully my voice holds out because I seem to be getting a cold. All right.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, CSW, nor its affiliates, nor any of the respective officers. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. CSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media are identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, fantastic. How is everybody doing today? Let's see. Drinking some tea and be in good shape. I was fine yesterday. Just woke up today. I had a cold. Anywho, so very exciting this morning. Reminds you why you want to have a hedge. You see the NASDAQ plunge, 64.30, 150 points on nothing. But that's what happens in an overpriced market. It doesn't take much for people to freak out and run out of things. Look at oil. We called the short up here at 57.50, and we got all the way down to 56 and change down here. So that was good. I mean, the stop obviously should be 57 now, so you can make at least 500 per contract on that one. But, that was an easy call, too, because we knew it was a disappointing oil report. So that's, these are things you can always make money on certain things because it's so obvious and you know exactly what's going to happen. So when you see an oil report and they show a build in gasoline and a build in and an overall build in distillates and the net build is there, you know that it's not going to support the price they're at. And only, you already know we're all jacked up over OPEC, which probably they're going to sell off after that anyway because it's not going to be a big deal. All they're going to do is extend the production cuts they already have if they even do that. If they don't do that, that's going to be a problem. And we just got word today that shale production in the U.S. is just under 10 million barrels a day now, so we're at record high shale production. So, everything they cut back, we make up over here. So all they're doing is giving us market share. That's all OPEC's doing in the end, is they keep giving us market share when they cut back. It's not smart. And it's not just us, it's Canada and Mexico too. And, any of the non-OPEC countries, they're going to be doing the same thing. So hey, you don't want to supply oil? We'll supply oil. As long as you can sell it, who cares? Especially for $55. Anything over 50, anybody's profitable at $50 or higher. So the incentive is there, just pump as much as you can. The only thing that's really holding it back is people don't believe that it's going to stay over 50. Otherwise, they'd be investing more in drilling. But they think that it's a short-term thing. They don't think it's a long-term thing. You see that by the contract spread. All right, what else is going on? It's not, and obviously the Dow's up anyway. All the Dow did is pull back from the crazy 23,950. We're about to 24,000 on the Dow. The S&P is up in the 26s. There's no particular line that stopped the NASDAQ. It just finally stopped. And the Russell, too, is completely crazy. They did make it turn around at 1550, so we'll watch that and see if it's anything. But it's just an up and up and up thing. It's crazy. I can't believe the Russell isn't pulling back with the NASDAQ. That's even crazier. Very annoying. Silver plunged again. We were at 1720, and it's fallen down, and it blew through our 1690 line where we like to buy it. and now we're at 16.50, and of course I like it down here. The dollar isn't particularly strong. It didn't do anything magical in the last 2 days. It's just the commodity suddenly fell out of favor. Weird. Coffee, we already took our profits on the coffee. That was a good move for that. What else? Natural gas, we took our profits on natural gas at $3 too. We're getting the pullback we expected on that one. I think these channel trades are pretty obvious to call. So, if you see them, play them. And I'll show you what I mean on these future shorts if I can find them. Here we go. So, hours are better. All right. There's no pattern to the markets here. If you look at the NASDAQ, though, at least you can kind of see what happened to them. They were, they've been topping out at this level at 64.25-ish all week, over the last week. And people are just, look, it's like I said this morning. I said, look, I can't take it. I can't stand having all this money at work in the market and not taking a profit. It's crazy. You have to take something off the table. We've got, here's a long-term portfolio. I guess I should say it. We're at 1784, and we've got 135 in cash. That's 70-something, 75%, 80% cash. So, we're already way off the deal. I don't like this, though. I don't like having anything. It's crazy. These numbers are nuts. And yes, some of them have gone away from us as far as we sold Apple January 155 calls, and they're at 168. But we sold them for $8, and they're only at 15, so it's not horrifying. It's protecting a much larger long spread. But the thing is, we never thought it would go this much higher. We thought 165 was plenty, and it's still at 168. Everything just went higher than we thought, further than we thought, crazy stuff like that. The big difference in the long-term portfolio was the Chipotle. So we had a big Chipotle position, and they turned around big time. These are not, by the way, adjusted. We did adjustments. Where were they? I'm not getting good action on the clicks. For some reason, when I click on something, it's not really being very responsive. What did I say about Chipotle? Control F. Oh, we did adjust it. See. So we're actually doing better. It's embarrassing. It's embarrassing to do this good because it seems crazy. We're doing much better than this because this is the old position. I haven't made all the adjustments yet because it takes me a week. It takes me a whole day on the weekend. I haven't done it yet. But the call from, it was like the 17th when we did this review. The call was, Chipotle finally calmed down. We're not so bad off. Let's take advantage and buy back the short 420 callers at 11. So you see the 420 callers now are, they're still 11. Okay, so that's not so bad. And then we also, that's weird. Why are they still 11? Well, anyway, we bought them back at 11. And the next move was, and we rolled the 280 calls, 220. We doubled down on this one. Oh, that's nice. I'm very pleased. We doubled down to a bigger bull call spread. And we rolled the short 350 puts to the 300 puts. So we did all good, very bullish adjustments that we made on that position, and now it's finally taken off. Which, here it is. So the thing is, we called for these adjustments over here, and now they're up here. So it's not a big difference yet because it went down before it went up. But, that's what you got to do. If you're going to be a fundamental investor, you've got to take advantage of a pullback and aggressively move on your position. Not for no reason. You've got to reevaluate it and say, is this pullback logical? Should we sit there? One point I want to make is because people people act like there's a big deer in the headlight kind of syndrome to stock drops. And no, and we weren't in Chipotle, when it was falling, so that wasn't the issue. We came in around here and decided to start a position. I'm guessing now. I don't know for sure. I don't think we know from this either. Let me see if it's been adjusted. No, not that one. So 727 is probably the original date for this new position. We had one previously that we cashed out, but 727 was the newer position, and that was down here. Yeah, 350. Huh, that's right. All right. So, now obviously when I enter the position, I do more work than when I adjust. But at the time, I said, well, 350 is a fair enough price, and we were happy with what we thought was going to be the bottom. Now, we didn't put our foot down because it was only 10 contracts. It wasn't a huge position. We've now taken a huge position because now we're way down here, below 3. We got a 20% discount from our first entry. And when it drops 20%, then we take a close look and say, did it drop 20% for no reason or for some really good reason? It dropped for pretty much no reason. I mean, yes, it dropped for the same reason that it dropped the other 40%. So the bonus drop was pointless. It's like we knew all the stuff that gave them bad earnings report. We knew that was going to happen. There's no surprise to it. Oh, I forgot tissues. Hang on a second. Thought I was asleep. Okay. That was weird. All right. Anyway, where were we? Oh yeah. So we know we liked them at 350, and when it went down to 300, we didn't get out of the position. We said, you know what, we still like them. We think it's down for bad reasons. And when it dropped on our earnings, we said, man, we definitely like them now. So we made a call to double down. And it's a 2-year play. So it's not like we expect them to come back tomorrow or anything like that. This is a surprise today that it popped so much. But we're thrilled if it gets back over 300, especially because we have a very conservative position, which is the 250, 350 full call spread. So we're here, and we max out here. It goes over 350. We don't even care anymore. We just want to go back to 350. It's not a very aggressive position, but now we have a pretty aggressive amount because this thing is expensive. It's $100 times 2,000. This is a $200,000 position that we now have on Chipotle. It doesn't cost us $200,000, but it's a $200,000 value position. Cost $80,000 less the price of the puts, which were $80,000. So it kind of works out for us. So it costs us very little cash. Yet we could get a return of $200,000 at 350. At 300, we get $100,000. We're fine with that too. So we're fine where it is right now. But anyway, so little things like that, especially in the long-term portfolio, we have so many value stocks that move up on us. Like here's Dine, here's Disney. Why are we having such a good day? Here's Gilead. I wouldn't say anything. Look at Macy's made a huge move up today. And again, these are not adjusted. These are still the same positions we had last week before we made all the adjustments. Wow. Okay, well, sorry, it's Chipotle here. I'm like, wow, that one went up $8. Here's Bed Bath & Beyond. We were just talking about that in the chat room. Amgen's having a nice day. ALK, last in there, is one we just talked about. I just said that yesterday, how they're still good. ABX, now here, that's a nice crazy low stock. I love them as a new trade. What's this? Apple. Oh, Apple went down. But we thought Apple was going to go down, so that's not even an issue. It actually didn't hurt us because our spread barely budges, but the short calls, we gain back a bunch of value. So that's how that works. That's why you have such a stunning day in that portfolio. So Silva's getting hit today. Yeah, I didn't see anything on it, though. See if this says anything. I don't think so, though. I think it's just a metals thing. An update precious metals, U.S. stocks will close Thursday, blah, blah, nothing. Gold miners leverage, gold receives lost ground. No, there's nothing, there's no rhyme or reason to what's going on today. No, man. I think you're taking money off the table. LB, bull call spread, thoughts. LB, where is it now? It depends on the spread. It depends on what you're taking off the table. It depends what your profit is. It's a lot of depends. Look, LB, first of all, as much as it's gone up, it's still a good deal. It's just that it's hard for us to sit there and pay up for it because it's really LB. Now we're at 15 times earnings. It's like when we were looking at it, 10 times earnings. And I was like, oh, that's crazy. This is reasonable. Now, and obviously, people pay. The S&P is 26 right now. So, this is what's considered a bargain. You can buy something for a lot of time earnings. And earnings are probably going to grow, so there's several reasons to pick up this stock. So I don't think it's cheap. I don't think it's going to go below 50. Or not never, but it won't stay below 50. As you can see, the 50-day moving average is coming up. The 200-day moving average is flattening out. So the 50-day bursting through the 200-day is going to be bullish. Just, when you look at the chart, don't look backwards. Think forward of what's happening. The 50-day moving average is coming up at this rate. It's going to cross the 200-day moving average here, which is about 2 weeks from now. So that's going to be, even if it pulls back, that's going to be a bullish signal. If it pulls back, it'll bump into the rising 50-day moving average, okay? And it's probably going to channel up along that until it gets to a PE of 20, which is actually quite far from now. You're still another $10 up. You can hit 60 before this thing has a PE of 20. So, in answering the vague question of you have a bull call spread, if you have a bull call spread that's 80%, 90% of the money, yeah, cash it out. I'm sorry. If it's till next year, then what do you need it for? Why are you going to wait a year to make 10% more? It doesn't make any sense. If on the other hand, though, you're going to make 10% more by January, well, I don't know. Why would you not wait and get the 10%? I understand it may be a pullback, so that's the only reason. It depends on how much fear you have. But again, I'm not really concerned about this stock going down. The rule of thumb, if you want a really vague rule of thumb, if your position is at 50% of gold, and you've got, now, how do I explain this? Let's say it's a year. Now, you have to adjust your time frame for whatever time frame you were trading. If you're making a month trade, then you're talking about 2 weeks. But in a year trade, if you have 6 months to go and you're at more than 6 months to go, and you have gained more than 50%, you have to start thinking about taking off the table. You're ahead of schedule. And certainly if you get to 70%, that's just crazy. Okay? If you make 70% in 6 months on a 1 year trade or in 2 weeks on a 1 month trade, then you should be taking off the table. That's it. The party's over. Unless, of course, it's so in the money and so safe looking that you have no reason to take the money off the table. But you're in diminishing returns. At that point, you have the 70% gains invested in addition to your original position, and so your risk reward has changed drastically. Now you've got twice as much risk as you do reward. Once you cross 70%, your risk reward ratio is now against you drastically. So unless you are more than 80%, 90% sure that everything's going to be fine, there's no reason to risk it because the risk is too high compared to the potential reward. As you get closer, so let's say within 2 months, if you're at 70, if you're at 75, 80%, you should be taking the money off the table. So before the last 20% of the period that you're investing in. So if you're up more than 80%, with more than 20% to go, take it off. And if you're in the last month or the last 10% of when you've invested, then really around anything over like 85 to 90%, you should be, probably cashing in. It's not even, and again, unless you think it's so safe, like if I sold the $45 puts and they're expiring in January, do I think they're going to fall $7 between now and January, even if the market turns down? No, I don't. I think that this line is certainly going to hold. The 200, remember, the 50 days rising. So I have good reason to think that it's going to hold aside from the fundamentals, that I think the stock's in good shape. Also, there's no earning catalyst. So other than the whole market selling off, I don't have any reason to think I should get out of that trade. So that's between now and January. Then if your time frame is longer, then you're like, well, let me even get out of a longer period. Which is why you're more prone, if you have more time left, you should be more prone to taking it off the table. So that's a good general rule of thumb. You always have to think of it as a new trade. Don't get married to your trade. Think of your trade as a new trade every time. And say, should I spend this much money to make this much money? Is it worth it? And if you can't justify it, and if you're even a little bit nervous about it pulling back and whatever, then take the money and run. We'll find another trade tomorrow, right? Let's see. Oh, okay, good. All right, so speaking of which, we just did a, what did we do? Oh, the top trade. Okay, we'll show them the top trade. So we just sent out the top trade alert yesterday. And we featured, oh boy, what a great set. I'm telling you, man, these top trades are amazing. I don't know how I do it. That's crazy. All right, so we had 3 trades for the top trades. We had Hanes, which is our trade of the year, and we'll talk about that next. Macy's, doing really good today. Look at Macy's today. Now, it's kind of a problem because I don't know if things go up because I said something or if they just went up because my timing was really good. This, this is today in Macy's from 22 to 24, so 10% today. Officially, they're up 8% at the moment. I wrote the thing yesterday. It was here when I sent it out, 21. So we're up, almost 15% since then. This is 24, well, 21 to 24 is 3, left. Okay, so like 12%, whatever. That's 2 days. So do I have really good timing, or does my article, which is read by lots and lots and lots of people, make people rethink retail and start pushing money into the thing? It's very, very hard to say. Unfortunately, I do reach a lot of people. I have a really large audience. And so it's a Schrodinger cat kind of thing. Like, I don't know. Quantum theory, it's like I don't know if my articles cause the thing that I'm writing about. So it doesn't mean I'm right. It just means that I push people into something. So that's what I worry about when I'm doing these things. And you have to worry about that too. It's like very important that you realize, like, maybe it's just because Phil said something and it's going to burn out. Like, I don't want to be like Kramer, because Kramer loved stampeding people into stocks. That was his favorite thing to do. He loved to pick some stock out of the blue and say, oh, watch me make the stock go up. It feeds his ego. I don't want my ego fed. Okay, I want to be correct in my advice. I want to make the correct call, and that you'll only find out over the longer run, not over what happens 2 days later. That doesn't prove anything. So, be careful and don't chase things, especially if I just talked about it, because, it may have just gone up because I said something, so I worry about that. But anyway, so, especially as yesterday, it was a top trade. I think somebody told me today that my article on Seeking Alpha, which was essentially the same article talking about that we like Hanes, so top trade and these other stocks. It didn't specify the trade, but it said we like the stocks. That's like the top article on Seeking Alpha today. A day later, it's still the top article on Seeking Alpha. That means, hundreds of thousands of people are reading this thing and possibly acting on it. And I made some good. Well, let's take a look at what I wrote. I'll tell you what I wrote yesterday. It's a good article by Badnick. Okay, so I talked about Macy's. Says our second choice and why we like him as a real estate play and so on and so forth. And by the way, this is why I can't be like a professional analyst, because to me, they love these professional analysts. They love to have them write up like a whole book of all this bullshit about a stock and so on and so forth. And meanwhile, if you ask me to analyze a stock, I'm going to find the two important things to talk about. I'm going to summarize it in one paragraph and say, there you go, end. This is my entire take on Macy's, which, now it takes me just as long as any other analyst to review it and research these things. But at this point, when you ask me, what do you think of Macy's, I can't write up a 25-page report. I'm just going to tell you one paragraph. This is why we like it. And Macy's was our second choice for trade of the year. It came in just barely, got beaten out by Hanes. And only lost because Hanes is safer. That's the only reason, because Macy's could make mistakes and trend lower or not make any progress. That obviously is already not happening. But Macy's wasn't as safe as Hanes. That's the only reason. Because we can make, the Hanes trade is some crazy amount of money. Anyway, I can tell you here. The Hanes trade makes 5,100%. So I don't care if, this is the thing about the trade of the year mentality. I don't care whether it goes up or down a lot. That's not what I'm in it for. I care if I can safely position myself to make at least 300% in a way that I feel like 90+% certain that I'm going to make the money. And so with Hanes, I felt more comfortable about that than Macy's, but that didn't stop me from putting out a top trade on Macy's too. We already have Macy's in our portfolios. We have them in every portfolio because we love this stock at this price. But for a trade of the year, I had to lean towards the stock that had a higher percentage chance of not going lower. That's all it was. Macy's could run into more financial trouble. They may have, if the economy tanks next year, their valuation, in my mind, is very much based on the real estate. And so if the real estate holdings come into question, then you've got big problems with valuation. Hanes isn't like that. Hanes makes underwear. They have some stores, but they basically make underwear. That's what they do. So it doesn't matter to them. Obviously, they can sell less underwear in a recession, you would think, although underwear isn't really the kind of thing you don't buy just because it's a recession. Although I remember, holy cow, I mean, when we were kids, we had underwear. I mean, it would get holes in them sometimes before we got a new pair. So, now it's like, geez, I got a drawer full of it. It's like crazy. Which is really silly when you think about it. Because, nobody, especially for guys, nobody's seen these things. I don't know why I need so many, but it does prevent me from having to do the laundry more than once every couple of weeks. So that's the main use for underwear, is to not have to do the laundry so much. It's also the reason you have a closet full of clothes, I guess, also. Let's see. Anyway, where were we? What the hell are we talking about? Macy's, Hanes. So the top trade alert. So officially, the top trade on Hanes. And again, it's the article's right there, so you can read all the logic and everything in this article. We talk about GE and why we like GE. We talk about Hanes. We talk about all of our contenders for the top trade. Stop doing that. There we go. Chipotle, all the good stocks today. See, this is what worries me. All the stocks that are booming up today are ones I wrote about yesterday. Even Chesapeake. So the trade we decided on was, I didn't think it was terribly aggressive, frankly. I mean, we're selling 15 of the 20. Now, this is the options opportunity portfolio. It's a started out as a $100,000 portfolio, but now it's up. It's not up 300%. That's again because something's expired. So let's say it's up. I mean, 290. I don't know, 250, whatever. So now it's like a $350,000, $400,000 portfolio. But still, we mostly make trades that are in line with the original $100,000. I don't want to like blow up the trades and make them huge. Some have organically gone big, like this Apple trade. You wouldn't have a $100,000 portfolio, but it's just because we keep rolling the profits into a bigger and bigger trade. So like we start off long on Apple with a fairly small position like 2 years ago, and what we do is instead of cashing in though, we keep taking advantage of the profits and we roll it into another spread that's bigger and wider and so on and so forth. So at this point, this Apple spread, holy crap, is a $180,000 spread. We didn't pay any money for it. The net cost of this spread to us is zero. It's probably less than zero. I think we even have profits off the table. But if this goes well, and well is only Apple at 170, we make $180,000 profit. So our next 2 years' worth of profits at 20% in this portfolio are assured by that one trade. Well, not 20%, 25%. We can make 25% for 2 years in this portfolio if this one trade goes well. I mean, that's crazy. So, what was I saying? So anyway, so sizing. So for the options opportunity portfolio, we try to make the trades in the range that we would trade a $100,000 portfolio. So they're generally small batches. So keeping that in mind, what was the setup here? So 15 Hanes, $20 puts us at $350. Again, one of the reasons this is a trade of the year is because if Hanes goes bad, they make underwear. They don't have a huge amount of debt like Macy's does. They don't have operating costs. They don't have massive amounts of employees. They have a lot of employees, but not like crazy retail department store kind of numbers. They don't have a huge tax base from all the stores they have, so on and so forth. And they're not losing customers to Amazon because Hanes sells their stuff on Amazon. So there are many, many reasons. So if Hanes goes bad, I'm a lot less worried about owning 15 times 20 is going to be $30,000 worth of Hanes stock. If Hanes goes below 20 and it gets assigned to it. I don't think that it's very likely they'll go below 15. And so our loss would be 5 times 15, $7,500 is basically the risk. Now, margin-wise, it depends on your broker and how much margin they charge you for something like this. The margin on in Thinkorswim, this is an ordinary margin thing, HDI. So if we sell the $20 puts, and we're going to sell 15 of them. Excuse me. And how much now? Oh, so they popped up so much you can't get this price. $350. They're $310 now. That's not bad considering they're up like 50-something cents today. So what's the margin? The margin is $2,000. So it's not a significant amount of margin on a trade like that. So your net margin is $2,000 selling it, then plus the other cash that you put into the trade would be this money, the $5,000 here. So it's $5,000 plus $2,000 in margin. It's $7,000 cash in margin. And how much do we make? We're going to make. We get back $12,500 plus it's a $250 credit to start with. So you're going to get $12,750 against, like I said, $7,500 cash in margin. So that's what we look for. And The way we run our portfolios, because all of our portfolios, even the options opportunity portfolio, is, well, we only have 142,000 in cash in this one, so we're only about 30-40% cash in the options opportunity portfolio. It's our lowest one, and that's because we did get aggressively bullish in our last round, and we added a bunch of positions to get more bullish. Why? Well, that's why we're up so much. But we do that because we got tired of not making money while the stock market was rallying. How's it doing now? Is it still rallying? What's going on? Really? Yep, still rallying. So, we didn't want to miss out on all this fun. But we also have some pretty big hedges, just in case. We have TZA over here. We have QQQ somewhere. SQQQ. There is SQQQ is another hedge. We have SCXY is another big hedge. So we have a lot of hedges protecting all this. But anyway, back to the trade. So we're obligating ourselves to own $30,000 worth of things. We're buying the bull call spread, 1823, and we're getting 25 of those. That's why so those will pay $12,500 at 23 in January of 2020. So that's that spread. Now, since we sold the $20 put, if it changes over 20, then the puts expire worthless. So as long as it changes over 20, our net credit of $250 is the least we can possibly make. But since it's over 20, we're also going to make 25 times 2 for the 18 calls. That's $5,000. So $5,250 is what we make for anything over 20. Let's focus it on a $250 credit. We get $5,250 back. So that's a great start. Okay, that's our base. So as long as he's over 20, that's our goal, and we're already 1,000% return on the cash deployed. So that's why that's our trade of the year. I mean, it's almost bulletproof, except obviously the whole market could collapse and take things with it, whatever. But it's such a trade that you think, like, how is this thing going to lose money? And your break even on the trade is not even 19, because we have 25 of the 18 calls. So even at 19, we would lose $1,500 here, but we'd make $2,500 on the $18 call. So at 19, we're still up $1,000 plus the $250 credit. So at 19, we still have $1,250, which is still 4 times more than we started with. So it's pretty good. So we have to get to like 1875 or something like that before we're actually losing money. And that again is why something becomes a trade of the year, because you're like, the 1875, that same logic with silver wheat. And I'm like, well, that kind of price, I want to own it long term. It's like, yes, I wouldn't mind owning 2,000 shares in my portfolio at net 1875. That's fine. And not only that, though, but it's like the opening move of a chess game, because basically that's only where we'll be at that moment, but then we're going to adjust it. So, so we're starting the base at 1875. We'll certainly roll the position and adjust the position and make it cheaper. So our net entry will be down around that magical 15 mark where I said for sure it's worth 15, even in a complete crash. So again, another reason it becomes a trade of the year. Very, very comfortable with even in a worst case scenario, still comfortable with the adjustment. In a worst case scenario for Macy's, that their creditors are circling the wagons. Oh, that's not supposed to read. Jesus. Why is that? So if the creditors are circling the wagons, if they default on something, if who knows what, then maybe I don't want to own long term. But Hanes, they just sell underwear. It's like long term, I think people are going to keep wearing underwear. So it makes it an easier target. In the long-term portfolio, we set basically the same spread, but just in a larger amount. That's all. So there's nothing fancy there. Now Macy's, we already had it, but as a new trade, I talked about the setup of doing this. You buy 15 of the Macy's. You sell 15 of the Macy's $20 puts, which was, notice it's less aggressive because with Hanes, well, it doesn't seem that now. With Hanes, we were down here and we sold the $20 puts. We sold puts that were higher than the strike, and that's an aggressive move, except for, obviously, as I'm saying, I feel extremely comfortable owning Hanes at 20. With Macy's, we didn't do that. With Macy's, this is as of yesterday, so here. With Macy's, I gave myself 10% cushion at 20. So again, it just shows you that I'm more nervous about Macy's than Hanes. But here we do the same thing, though. We sold 20 of these. We're obligated to $30,000 worth of Macy's, and we're buying 30 of the bull call spreads. So here, the safety is costing us money. We're netting in for $915, so we got to take $1,000 out of our pocket. But it's a $21,000 spread. It's going to make $20,000 if all goes well. And all is already going well because our target is 25, and they're at 24 now. So it's not bad for a day. Now, obviously, the premiums on these are going to stay there for a while, but that's all we need is that it finishes there at the target in 2020, and we're going to make 2,195% back on our cash. So and again, that's why something becomes a trade of the year. It's not just the stock that I like. It's not just I think it's in the right place at the right time. And by the way, timing is everything. I'm not generally a big on timing things exactly, but for the trade of the year, I always try to really, really focus on the timing. In fact, top trades, that's one of the reasons that top trades do really well is because those are the ones where I'm not just about the position, but it's also the timing. I really feel like it's the right time to get in. That's why it becomes a top trade. It's not just because it's a value like our LCT position, but it's a value and the timing is there too. So Macy's, same thing, that would pop like crazy. But the point, and we've owned it for ages in our portfolios. In the options opportunity portfolio, see we have Macy's. We have 20 of the bull call spread, and we sold some of the short calls, which are now in trouble because they just went in the money, but we only have a half sale on the short calls, and we have some short puts. So all is well there. And I don't know if we made an adjustment when we did it, but whatever. We may have adjusted these positions. I haven't updated that. In the long-term portfolio, we got we don't even have short calls in the long-term portfolio. We have 40 of the 1828 spread. So pretty aggressive target. We're targeting 28 in the long-term portfolio, and we got 40 of them. But it's a great trade. Look at this. It was 15-2. Look at this. I love this spread. It was 15-2 for the calls. It was 7,800 we collected 7,800 for selling the short calls, another 7,800 for selling the puts, because these cowards thought it was going to go down to 18 or less, or stay at 18 or less. This is only for 2019. We're going to collect this money in just a year from now. So we netted into this trade for zero. It's a small credit for the net of this trade. But this trade is going to make $40,000 at 28, and we're already at 24, so we're already $20,000 in the money. That's nice. That was a really, really good return. But even yesterday though, this trade, like I said, is going to make This one will also make $20,000 just as a brand new trade, laying out just $915 in cash. Oh, and let's talk about some of the margin things for a bit, because somebody asked me about that today. If you have an account, get a stock account. First of all, the money in the bank isn't making you anything. So if you can improve the cash position in your broker account, I'm not saying to trade it. I'm saying to just put the cash into your broker account and then utilize the margin buying power you gain from the cash to do simple things like selling puts, which we talk about a lot. In fact, yesterday I pointed out that, I don't want to get too distracted, but yesterday I pointed out Chicago Bridge and Iron, I think it was. So the Chicago Bridge or Cliff? CBI. Nope, that's too much, so it must be Cliff. CLF. There you go. It's still 230. No, it's a 7th. Wait, what? Damn it. That's not what I was talking about then. I thought it was Cliff. All right. You know, it's going to bother me now. Now I got to find out what I was talking about. No. Well, let's see. What is 16? All right. Okay, I said 5 like 100 times. Huh? Right $5. I was talking about. I'm sorry. You're kidding. What was it? All right. Did I say $5? GNC. Damn it, it was GNC. So yesterday, this is our member chat room for those of you who aren't members. So the chat room is just simply the comments below the post. So here's yesterday's post, and we had a whole bunch of trade ideas and showed a whole bunch of stuff. And then we started talking about then we talked about more trade ideas once the market opens. And Louis me, I'm the commenter. He was talking about underwear. We talked about some stuff, and then I mentioned GNC, which I now lost. Oh, yeah. There it is. So Pat said something to me about, how about GNC? We do like GNC. We have plenty of GNC in our portfolios already. And he said, what do you think about GNC for the trade of the year? And I said, you can sell 20 GNC $25 puts for $270. Now, think about this. And again, we were talking about what do you do with your cash? So you have your cash, it's sitting in the bank, and it's collecting 1.8% or something like that if you're lucky. And you're paying tax on that, which is crazy on the interest. So you're not keeping up with inflation. It's a complete waste. But you can put that cash in the broker account. Usually you're going to get at least 2 times in margin for it. So if you have $500,000 sitting in the bank getting nothing, or in a bond, even worse, because those bonds can lose value. It's even worse than cash, because especially in a rising rate environment, bonds are a terrible idea to have. But if you have $500,000 sitting around doing nothing, it's $1 million in buying power. So how much interest are you going to get for the year on that? You're going to get $20,000 on. No, I'm sorry. You're going to get $10,000 in interest on $500,000. But to make $10,000 here, these put to $2.70. I can sell. If I sell 20 of these in this particular stock, I sell 20 of these $25 puts for $5,400 for $270. The worst thing that can happen to me. The worst possible thing they can do to me is make me buy GNC for $5. But I already collected $270, so I'm buying it for net $230, which is less than half of where it is now. Well, especially yesterday. That's my interest, and I'm only tying up. And again, I'm not tying up anything. The margin on this is minimal. But if all I have to do is find a couple of stocks like this a year that I'm willing to buy with my $500,000. So the trick is to say, okay, I would be willing to buy GNC at $230, at half its current price. And in order to promise to do that, to buy 2,000 shares, there's only $10,000 worth of stock. But I'm going to collect $5,400 up front. So my whole net risk out of my $500,000 portfolio, my net risk is $4,600. All they can do is make me buy GNC for $5, and they've already given me $5,400 to do it. So that all they can do is make me buy $10,000 worth, and I have $5,400 cash. Now, if it goes up and I don't buy it, I still have all my cash plus another $5,400. So I've now collected on $5,000, $500,000. There's 1% right there. So if I do 2 of these a year, it's a 2-year trade, but if I do 2 a year, it rolls over. It doesn't matter, does it? So if I sell 2 of these a year, I'm going to make more money than I make keeping $500,000 in the bank with very, very, very low risk. Like my risk is owning a stock cheaply that I would like to buy anyway. Meanwhile, though, it frees up, it gives you so much buying power and so much margin power in your stock portfolio. And I'm not saying to use it, that's not the point, but the point is then when you make when you do use your stocks to make sensible trades like the ones we have for the trade of the year, you have no margin issue whatsoever. It's not even a thing you consider as a problem. It's just you have all this unused margin sitting around. And that way you don't have to tie up your trading cash in positions. All right, that's where these things can be really superior for you. Anyway, so we talked about the Macy's spread, and then GE was the other one I liked. GE's not going anywhere; you can still do this one. And again, with GE, we're being aggressive and selling the $20 puts. We're only at $18.50. I'm selling the $20 puts, but I'm selling $20 puts for $360, so my net entry is $16.40. All right, $16.40 is my net entry. That's down here at the bottom of this line. So I'm allowing for GE to go even a little bit lower by selling the put. Then we're taking the 15, and again, that's even lower. 15 is way down here. We're taking the 15.22. In 2020, my goal is for GE to be at 22. And if that happens, my $1,600 investment turns into $28,000. And that wasn't even my runner-up for the trade of the year. And I honestly, I don't know why. I've really gotten, today, I forget who it was. I forget, it was like Moody's or somebody said something that GE potentially becoming a credit risk if they don't, fix their cash flow and so on and so forth. They know this. And by the way, not a credit risk. They're like a triple A. They're just in danger of losing their triple A rating, which is important to them. They want to keep that. But all it's going to do is drop them down to double A. So they'll be the 10th best credited company in the world instead of the third. The company has huge cash flows, massive money overseas. Their business plan includes the fact that they expect to repatriate a lot of the cash they have overseas, which will fix all their cash flow issues and everything else for the next 2 years. Plus, there's also a good chance they have a nice return to shareholders. They might ship you back like a few bucks off of this trade. Like if you own the stock now, you may have to get a few bucks back when they repatriate their money, assuming, of course, the tax plan goes through and all that stuff. But anyway, so GE, again, solid company. I think there's very little downside risk to them. They're not going out of business. They're just experiencing a difficult and slow and painful turnaround where they're changing the nature of their business. They cut half the company away, and they left themselves with energy, medical, and transport. I think aircraft and trains and aircraft are still doing. But I think it's transport, Does this seem sensible for the 21st century? Transportation, energy, and by most of their energy focus is renewable energy too. And so think about China and all the money they spend on their infrastructure and building trains and all the planes that are being ordered that all need GE engines. There's really only two major engine makers, it's GE and Rolls. So, you've got all these plane companies need engines that are going to have, so they want to focus on the things that are going to make them the most money for the next, 20 or 30 years. And to do that, they had to cut a lot of stuff they weren't excited about anymore. The finance they cut because they don't want to be under federal scrutiny with all the financials. Because GE Financial put them in the category of being a too big to fail company in the United States. And they were not happy about being under that regulatory oversight. Because their financials were very, very aggressive. They're extremely aggressive deal makers back in the day. In fact, I had a $500 million line of credit with GE at one point because that's what they were just it wasn't like we weren't idiots, but they were the thing is they would give those out not that hard to do if you had building projects and things to get done. So they were good, aggressive lenders. They were great deal makers. You could sit down with them and show them your business plan and show them your properties that you're buying and so on and so forth. And they would look at it as a partnership. They would get in there and say, okay, good. It's like you're the kind of guys we want to be in business with and so on and so forth. They can't do that anymore, and so for them, they're not interested in the business. It was a huge money maker and whatever, but the nature of that business has changed. What hasn't changed though is government contracting, still hugely profitable. In fact, as you can see from when Trump came into office, he's talking about with Boeing and Lockheed Martin how, I'm going to look at these contracts really closely and blah, blah, blah. Meanwhile, he didn't cut anything. He actually added to the Lockheed order and he added to the Boeing order on both of them. So all you have to do is meet with them and schmooze them, and it's all fixed, which is why government contracts are so great. So anything in America, anything Boeing sells, GE is selling too. People don't understand that. When Boeing has massive, massive back orders and stuff, who do they call? They call GE and they need more engines. Huge business for them. So all this goes together for them. And the energy infrastructure, what are countries spending on? Countries are not spending on a lot of things, but they are spending on energy infrastructure. They're spending on transportation infrastructure. And of course, and you have no choice on medical, which is the other thing GE kept, because everybody's getting old. It's an aging population. It's one of the best macros you can follow. I wrote about this in my 2010 year in review when I was reviewing the next decade. And I wrote my 2010 outlook. I talked about this. I said, you want to be in the medical aging game. And at that time, you picked all the ton of biotechs and things like that for the next 10 years, which obviously are all through the roof now. But, that's obvious. You have an aging population. They're going to need more medical care. And the funny thing about it is the better we get at prolonging life, the more expensive it gets to prolong life. Because when and there's reasons that we're attacking the problem the wrong way. Not for business, we're not attacking it the wrong way, but for logical and society. You need to attack the problem by creating healthier citizens. That's something they do in Europe. They reward the doctors, which you can't do that in a private healthcare system, which is why they fight to keep private healthcare here. The doctors are on the government payroll, and the doctors are rewarded for medical outcomes of their patients, like more patients, less patients smoke, doctor gets more money. Less patients are overweight, doctor gets more money. So it's the doctor's job, if he wants to make money, rather than to dispense pills, his job is to make sure the patients don't need the pills in the first place. And that's how he maximizes his salary. In this country, it's the opposite. We reward doctors for having sick patients. So there's no real attempt to make people healthy, educate the population, so on and so forth. And of course, and to the point of they also engineer their whole society to be encouraged walking and being outdoors and things like that. We don't do that either. We encourage everybody to sit at the TV, play video games, and get in the car. It's definitely not, something's definitely wrong. Let's put it that way. But anyway, so GE takes advantage of all that stuff. Great stock. Also still cheap, hasn't moved from yesterday compared to the others. And fantastic. This is a really good spread also. So all these are good spreads. That's why it was a top trade alert. That's how they work. So where are we? Can you please look at BBY and see where it will meet good resistance as I'm trying to exit my 2019.35 strike. Sure, we can do requests. BBBY. I like these guys. I've liked them for a while. They're on our watch list. I think we actually own some in one of our portfolios. You know, when they were down here, I was like, oh, come on, you know, below 20. You know, look, again, I don't, obviously there's resistance at 30. You have good support at 21. It depends what you're trying to do with it. BBBY. This is another one of those very, very silly stocks because, is that real? $2 a share. Now P is about 10. Okay. So the P is about 10. And let's double check that. Financials, they are making $700 million quarterly. Yeah. Well, okay, figure Christmas is a big thing. So 126, 268, that's 4, 5, 75, 600. Okay, cool. Let's say 600. And how much do they cost? Ooh, market cap 3. Wow, that is a PE of 5. That's weird. So they're making $600 million. Or let's even say 500, whatever. But so the PE of about 6, that makes sense on the actual earnings. What doesn't make sense then is why was this happen? Why? Well, they're not distributing 2 per share. They're distributing 235, 291 here in 2018. Very interesting. It's very strange. So I guess because the earnings are declining, that people are really worried. Because even here, $3 against that is very strong PE ratio. Anyway, so I wouldn't sell them. I like them. I think they're in good shape. I think they're going to do well. They're still cheap down here. People are just waking up. Probably in the 30s is going to be the right price for these guys. So that one's another gem. Excuse me. Is this a long-term portfolio? Oh, there they are. Yeah. Oh, so we picked them up in October. Yeah, I couldn't take it in October. It was too cheap. I was stupid. Here, October. See, when it went below 20, when it went below 20, I said, "Oh my God, how stupid is that?" And we picked it up. So we've got the 20-27.50 spread. Oh, look at this aggressive sale. We sold the $25 puts for $7. That is aggressive. Wow, I'm so proud of myself. That's a really aggressive move. So when Best Buy was at 20, I sold the $25 puts for $7 because I was like, screw that. This is ridiculous. That's good. Boy, I like that move. So you can tell how strongly I feel about something by what kind of put I sell in the trade. And when I do that, when I sell a put that's 20% above the price, 25% above the price. When I sell a put 25% above the current price, I think that the move down is ridiculous. So in other words, where they are now is still below where my put price is. So my target for them is over 25. That was a good call. And see, here, it's another one. You see how, I want to point this out. It's real important. This is a 2020 spread. And everybody's like, oh, I don't want to wait for 2020 and whatever. That's not really what you're doing, though. You're getting the safety of a long-term spread. So that if it goes badly on you, you're not going to get killed. Meanwhile, though, the way I set this up, we paid $9,000 here, $10,000 here, cancels out. and here's $5,400. So basically, we're getting like a $6,000 credit on a 750 spread, 20 of them. So $15,000 spread with a $6,000 credit to start with. So this is 21. We get $21,000 back on an initial credit on the spread, and currently it's at 13 minus 14, 15 and a half. So 2,500. So come on, 6 minus 3,500. So this trade is already up $3,500 in 30 days. We started with a $6,000 credit, and now it only costs us $2,500 to get out of the spread. Therefore, we would keep $3,500 in our pocket in 30 days. That's how fast we make money on this spread. Meanwhile, though, had we been wrong, there would be very little damage because we didn't make a short-term bet where we were the idiots paying a lot of premium. We sold a lot of premium that kept us covered and allowed us the flexibility, should something have gone wrong, to make adjustments. We bought the $20 calls. In fact, I was actually hoping apparently that it would go down because I bought the $20 calls. If I had intended, if I thought it was going to rock it up the way it did, I would have gotten more aggressive on the calls so that we could sell some short calls. The 20s were not that aggressive of a sell there, but we were super aggressive on the puts to make up for it. But the reason I did that is because we had $6,000 in our pocket. So with $6,000 in our pocket, even if we sell below 25, we still have a credit of about $4 per position. So we're 21 would be like our net entry would be the worst case. And again, it's like chess. I know I say a lot of stuff and it gets confusing to you, like until you get used to listening to it. But it's like a chess game. I think about what our position is now, what our move is going to be, what our move is going to be if things go wrong, what our move is going to be if things go right. You've got to think several moves ahead of all the things you can do, and you also have to think of your positions as being fluid. They're not stagnant, they're fluid, okay? They're always in motion, and in 2020, we've got tons of different things that we can do. We can either take it off the table, cash it out. We can extend it the way we've been extending Apple and build a bigger position. When you're getting into a stock this cheaply, if your premise plays out, you can turn into a long-term position that doubles and doubles and doubles over the years. Let's see. Butterfly, in this market, short calls are getting hit. Cost. Where do you expect it in January 18? I have a 175 short call bleeding at Costco. Is that from our Butterfly portfolio? Is that what you're saying? Butterfly. Costco. We have 10 short January 160s, and we sold them to 7, and they're now at 17. You have $175 short. I had no pity for you. What, are you kidding me? A $175 short call? Dan, you're in way better position than we are. Wait, first of all, Costco's at 176. So the entire all right. COST. January. 175. Costco is at 176.50. January 175s are $6, but Costco is at 176.50. So this call is only $1.50 in the money, and the rest of the $6, $4.50 of that $6 is premium. So you say getting killed, but that's only because you're not playing it out. You're just immediately reacting to a spike up in the stock. Okay, if it expires at 176.50, these things will drop $4.50 in value. Not only that, though, But if you look ahead to April and say, well, what's $6 in April that I can roll to? You can roll to the 185, which are $5. So for $1, you can roll and I'm not saying do that now, let the premium expire first. But for $1, you can roll your 175 January call to the April 185 calls, $10 higher. So it's really not so much about whether you think Costco is going to hit 180 between now and January, but whether you think it's going to keep going up and make it up to 185. And even then, you can go to July, and I bet the 195s are like $6. 195s, well, they're $4. But again, don't forget, all this premium in the earlier months will erode, and so that $450 won't be $450 in premium in a month from now, and hopefully your roll will be cheaper than it is now, be more in your favor. But as you can see, you can get out to the July 195. You can get to the next January, and I know you don't want to do that, obviously, but you get to the next January and see what's $6 next January, and it's the 200. So at 175, the question is, are you worried Costco will be higher than $200 at the end of next year? Doesn't matter what it is now. It matters what you think it's going to be. You have to think ahead at what the next move is going to be and what you're going to do about it. So if we look at Costco's chart and see how they're rocking up and up. And Costco's a hell of a business. Really impressive operations. So this year, wow. All right. I mean, they're volatile. But look, this year, for all your hand reading at the moment, they were at 180. So they went up, they went down, and now they're up. So you're panicking at the up. When it goes down, you won't be panicking. You'll be saying, oh, my God, I should have sold more calls. But at the moment, they're up, so you're freaking out. They're pretty consistent like that, right? Up, down, whoa. So forgetting that, up, down, up, down, up, down. See the pattern? Up, down, panic, down. So there's really nothing to worry about here. It's if you sold something at the moment, it's in the money. If it goes more in the money, you will roll it to a higher strike. And if that goes down, you roll to a higher strike. And if that goes down, you roll to a higher strike. And meanwhile, your end point, worst case, is next year, $200. This year, did they go up $25 this year? Yeah, they did. In the entire year, they've gone up $25. Last year, did not go up $25. Year before, don't know, but probably about probably about $25 from this year too, because here's $150 and here's $125. So this is not a stock that is likely to go up much more than $25 next year. And since that's your safety zone, there's no real point in worrying about it, especially when the pattern of the stock is that it goes up and down like that. All right, so you just got to wait for the pattern to reassert itself. You have to be patient and confident. And by the way, I don't know what your spread is, but you always buy more longs too. If your biggest problem is that your short calls are in the money, buy more longs. Obviously, it's a good stock. It's better than you thought it was. Your long calls at 200. Well, you were pretty greedy then with your sale. But there you go. So by the time you get to 200, you can't lose, right? So if you keep rolling, get to 200, you're not going to lose. But the solution would be buy more calls if you have to, and then double the, and you always roll to a 2x on the short for the higher strike and make it a better spread for yourself. If it's over 200, worry about that when it happens. And there's no particular, and Costco's not that kind of business. They've got their membership business, which is great for them because it gives them a very, very firm base. They make a lot of money with the gasoline sales also, and then people, it's a significant difference. I go to Costco for gas, in fact, because it is significantly cheaper usually. So when I'm by the mall, I tend to go to that Costco station for gas if the line's not too bad. So it's a good business for them, especially when prices are climbing on gasoline. They've been climbing. And also, of course, their regular business is pretty good too. They sell a lot more expensive stuff than they used to. I mean, Jackie's going to, not Jackie, Maddie. My oldest daughter is going to college in the summer, and I will certainly be going to Costco to buy her like a dorm full of stuff. So it's like a go-to place to do stuff like that. Because where are you going to go? It used to be like maybe, Sears or IKEA. IKEA to me is not as, I don't know, it's like, IKEA is a bit much. If she wants to go to IKEA, she'll have to go herself. It's too annoying for me. But, there's not that many places. If you're going to outfit a dorm and you want to get stuff and save some money, Costco's like a great place, right, for that kind of stuff to just buy. Because they got everything. They got furniture. They got all the accessories you might need to take up to college. They got lamps. They got all, everything's like there and cheap. So, TVs, things like that. So they've got that kind of business. So it's not about, they're not a Walmart kind of place. They actually have some pretty good stuff there. And I think that, but the growth is a fairly steady sort of thing. It's not like we expect them to bust out and go higher, in a significant way. They're going to just steadily keep growing, keep adding, and keep opening new stores in an incremental fashion, which is what they do. And that's why they seem so cyclical, because their reports are they spend a little money, they expand, they spend a little bit more money, they have a low cash flow fourth quarter, then they spend some more, then they wait, then they get some profit, then they spend some more money. It's just what they do. Any thoughts on price action, Apple? Oh, earlier you mentioned you thought it was due for a pullback. Yeah, sure. Well, I mean, again, what price action? I mean, it has barely moved. AAPL. In the grand scheme of things, well, this is the grand scheme of things. This is what Apple does. Same as Costco, kind of. But Apple's more pronounced up. But look, they go up, and they go up, and they go up, and they go up. And in between the upping, it goes up. This little thing goes up and down and up and down and up and down while it's doing that. So if you want to say what's Apple going to do, it's going to go down a bit, and then it'll go up, and then it'll go down, then it'll go up, and then it'll go down, then it'll go up. You guys, you focus too much on the short-term moves of the stock. It's like, is it a good stock or is it not a good stock? Like, when we had our, not top trades, portfolio. So what did I say about Apple? Control F, AAPL. Seriously? Okay. TL. There you go. Okay, so despite being on track for $180,000 payoff from that $44,000 entry, we're only net $60,000 at the moment. So it's a piggy bank that pays off big once it's time to open it. Not much to do but watch and wait because we're on track for a gain. Good for a new trade. So what was that trade? That's this is the butterfly trade. Oh, and here we sold 30 of the short 160 calls. All right, now I wrote that on the 14th, and Apple on the 14th was, wrong chart. So Apple was right here on the 14th. We sold the 160s. Why? I want to protect my gigantic long position. That's the main reason. I thought Apple was going to be selling off. It went up to 175. 175 is a lot higher than 160. But did I panic? Did I say, oh, my God, we got to move these things. We have to change our position, blah, blah, blah? No. It's normal for stocks to go up and down. Sometimes you will be in the red. Sometimes you will be in the green. Hopefully, when it gets to expiration, you will have more things in the green than in the red. You cannot win them all. Hopefully, you don't lose them all. But that is that's the point of the game. In selling short calls and whatever is to, well, first of all, notice that we don't fully cover. We have 60 longs and we sold 30 shorts. And they're offset by 20. And the 30 calls are offset by 20. So we didn't really sell them for $7.20. We sold them for $15.20 because we sold the $8 puts too. And it's not possible for both of these to expire in the money. Either one's going to be in the money or the other one's going to be in the money. They can't both be in the money. That's not a possibility. So we collected $15 against the 160 calls. Our target is 175 at most. So I'm not even going to think about warring at 175. Meanwhile, though, we've got a whole year to roll before it's even in problem. It's the same thing. I look at the next quarter, the next quarter, the next quarter. So whether Apple goes to 175 or not in January, I don't care, because I rolled the 160s to the 170s to the 180s to the 190s to the 200. I only care if I think Apple's going over 200. And if Apple's going over 200, I'm going to double down on my long. Well, I mean, I'm only half covered, so I can still roll this to 2x something. If Apple's going to 200, then this 140, 170 spread for $20 is going to pay 30. So I'm going to make 50% on this spread. So I'll buy more of those if I think I'm in trouble. Because the only way I'm in trouble here is if I'm going to make 50% here on a much larger amount of money. So it's really hard to lose in the big picture. But you've got to learn to focus on the big picture, not like worry about Apple making a channel. It's just trading in a range that it always trades in. Just go to the long-term chart and see. You can easily have drawn this line. You can easily draw this line along the top and this line along the bottom. And you would say that over the course of the time you own it, it shouldn't be higher than this and shouldn't be lower than this. And if it breaks that, then you wonder about what you did. But as long as it's in that range, what are you going to do? That's the range it trades in. Hopefully, when we get to January 15th or whatever the date is, it'll be below your target or at your target. If not, roll it. And then hopefully in April, it'll be at your target. But that's all you can do with these. And don't forget, the point of the thing is that you're protecting your long-term profits. We've got a fortune here. We've got this is 75,000. It started out at. Now it's 107,000, which is up 50% or something like that so far. And it's going to be 180,000 when it's done. So in other words, it started with 75,000, and forget this extra money that we collected for the puts and calls. So we really, if you take that off, it's 30,000. So in this particular Apple position, we started with 30,000 net dollars in. We're going to make $150,000 if it's over 170. I'm certainly not going to worry about my $12,000 loss on the short 160. Not if I'm losing 12,000 because I made 180. That doesn't make any sense to worry about it, does it? It's not a productive use of our time to worry about something like that. It makes no sense. You cannot win everything. You're betting against yourself. You can't win everything. You're going to lose something. And if I'm going to lose something, I'd sure as hell rather lose $12,000 here while I make $150,000. That's the one I want to lose. I want Apple to be high. I want Apple to be so far over 170 I never have to think about it. And if I end up paying these guys $12,000, $20,000, $30,000 out of my $150,000 profit, I don't mind. That was my hedge. That protected me from the downturns, and it allowed me, by the way, to have the confidence to let my incredible already 50% gain ride to go for the next 50%. That's what the hedge is for. It's to give me the confidence to say, you're looking at it the wrong way. You're like, oh, I'm in trouble on the short put. I'm like, no, my freaking long spread is totally in the money, and I'm going to make a fortune. It's a bummer I'll have to pay this guy because I hedged, but I hedged because that let me ride out the dips. Because when it dipped, I didn't worry because I had the short calls I was going to collect, and that would offset my worry about the dip. Because I know it's going to do this sometimes and do this sometimes. And sometimes I'm going to be excited and sometimes I'm going to be unhappy. But what I really want to do is feel confident holding on to it the whole time. All right, Apple. Right. What do you think about GNC? We just talked about GNC. I'm worried there's too much competition for them as a sports player, as every sports player. EGTV 12 things. What? Oh, their own products and supplements. Ah! I mean, when, come on, I can show you 1820s ads of so-and-so's miracle cure and blah, 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 and there's 500 infomercials on TV to supplement this and that, with celebrity endorsers and all that crap. The vitamin tonic scam has been around for hundreds of years. Elixirs, whatever you want to call it, they always sell these things. People always come and buy them. None of them particularly work better than the other. Look, hardly any of them work at all. And some have limited benefits, and it's all a question of how the consumers feel comfortable buying it. But all of them have phenomenal markups, ridiculous, phenomenal markups. GNC is in the process of reorganizing themselves to better appeal to millennials and whatever the hell they call the little ones, because they don't shop the way we used to shop, and they're more inclined to buy things online and so on and so forth. So they're changing the way they do stuff to some extent. They're making themselves more of a destination. They're putting in juice bars and things like that. So they have a juice bar and they sell pills. Instead of being a juice bar that sells salads, like most of them do, they're going to be a juice bar that sells pills, pills and juices. Boy, those Aussie bowls, holy crap, what a business. I mean, because my daughter, she got tired of paying $10 per Aussie bowl, so she went to the supermarket and got a bulk amount of Aussie stuff. It's frozen in packs. It's the exact same stuff they use in the store. There's no such thing as fresh. It's always frozen because it's pre-blended. Apparently, it's really hard to blend out and to open up the fruits and all that. So it comes in packets, already frozen and ready. And you just drop it into your food. You just drop it into a blender with whatever else you want to use, and that's that. So my daughter, because her friends eat these things constantly, and but I go to these places with her, and they are packed, and they are social places, and kids hang out there, and they eat their bowls, and they do it, and then they bring something home. It is a great business, and GNC is getting into that kind of stuff. So I think there's room for them and what they're doing. I don't think they're going to go away. I guess I'm trying to think. I'm trying to think. I would have said that about Radio Shack, but no, because it's different. It's not. Radio Shack is like a part, and you need a part, and so when it's on Amazon and on the web, why do you need to go Radio Shack? Other than the expertise. And by the way, Radio Shack, before they died, they did a really good job of putting in really good experts. Every store had like a nerd that knew everything about electronics. I was so impressed with the kind of people they had at these places. They could answer any question. They were great, but it wasn't enough because you can do all that stuff online, unfortunately. So GNC has the vitamin people. They know what they're talking about. They have the proper people to guide you through the concept, but I think more to the point that just becoming more of a destination spot for them is going to be the way to go. And I don't think they're going to get killed. I think they're obviously challenging the marketplace, but it's always challenging that marketplace, and that's something they're pretty used to dealing with. Just because other people have channels, the reason so many people are popping up with these things is because they're so profitable. And again, I wouldn't love GNC, and I don't love GNC. I like GNC a lot. It's because they're so freaking cheap. Okay, you could buy the whole company for $400 million. Okay, they've got 9,000 stores. They're a known brand with 9,000 locations. I don't understand how they have 6,500 employees. It operates 9,000 locations. I don't get the math of that. Probably because they're franchises. Well, that makes no sense, does it? What is that? So if they have $2 billion in revenue and 9,000 stores, that's not much money. Then it just goes to show you how much money these things pull in. So 2, 5, 4, 0, 0, 0, 0, 0, divided by 9,000. Is $250,000? Really? That's horrible. It's $250,000 a store. So that just shows you how much profit is in vitamins, because they only pull in $250,000 a store. They're paying the rent, they're paying the employees, and so on and so forth with that much money. But I think that, again, is because a lot of this is just franchise fees. I think when they say they have 9,000 stores, they've got to be franchised. There's no way they've got 9,000 in total revenue. Anyway, they're capable of pulling in. They didn't last year because they're revamping their stores and spending a ton of money. They haven't done that in many, many years. But if they stop revamping the stores, that's where the money is. Okay? They have 2.5 million, 2.5 billion, 2.5 billion here, and they make $200+ million. And you can buy the entire company for $400 million. A company that makes, let's do it again, $200 million a year. You can buy it for $400 million. They make 50% back on your money every year. Why would I not like that? Who else does that? Even Apple doesn't do that. It's a great freaking business. If they lose half of their business, they're still going to drop $100 million to the bottom line. And that's still worth it for $400 million. It's very hard to come up with a scenario in which I don't want to own these guys. And you're giving no value to their brand or anything else. I mean, their locations I wouldn't give any. I'm sure they rent them all, and they own anything. But I'm sorry. So you're giving no value to the actual brand of the thing, or their distribution networks and all this other stuff they've got going on. So I like them. I think they're priced below bankruptcy. It's really crazy. But certainly wasn't even in the running for stock of the year, because there certainly is a danger that they don't pull off their reorganization and such. NQ went long, I assume that is, at 63.05. I think the target strong line. Your thoughts on NQ? I don't know. Where are they? Let's see. Wait, you went long here? Oh, I see. You just went long this minute. I assume. I mean, unless you held it from way back here and are finally seeing something. No, I think you've got almost a 2% drop in the Nasdaq today. We're finishing week. I'm not enthusiastic about this, and I think the market's way overdue for a pullback. I'm expecting something much worse. So I'm looking lower. I'm not really looking for a bounce. You had a bounce, and that was it. And the bounce was, and again, the bounce is weak. If you fall from 64.25 to 6,300, that's 125. So a weak bounce is 20% of that. Is 25 points is a weak bounce. 63.25. A strong bounce would be 63.50. We did not make the strong bounce. We failed. We hit the weak bounce, went a little bit over it, failed, and now we're coming back to the baseline. And we are probably going to follow through and fall further. So we will see. But that's, if we're finishing down here, back at this level, or coming back, especially if we come back here, which is this is like the 2.5% line down here. If we're finishing that far down, and this is if you want to go edge to edge, then you would call the fall. And I'll show you. You'll see a strong bounce here. If you call it from 64.30 to 62.85, oh, I can't. I have to do math. can't think because I have a cold. What do we say was 62.30 minus, no, 64.30 minus 62.85. That's 145 times 0.2 is 29 plus 62.85. All right, so it's 314 is a weak bounce. Right here is a weak bounce. All right, and plus, what was that number? Oh, I forgot what the number was. Was it like 29? So let's say plus 30 more. So then, if 14 is a weak bounce, then 44, then 44 would have been the strong bounce. We didn't even come to it. So that's a strong bounce line, even if you do it from spike to spike. So in either case, you're failing the weak bounce line. No matter how, and this is basically the 2.5% rule down here. So you're almost guaranteed to get at least a weak bounce off the 2.5% line, and we're now failing the weak bounce. So no, I don't like the long. I think these are all. Everybody's in denial up here. I think everybody's going to come tumbling down. I like the Dow short below the 2,900 line on YM. I certainly like the Russell short down here below the. Well, we were talking before 1550. I like the Russell short below this line, or below this line. Any 5 line it crosses with tight stuff, I would play it. I think it's going to come. I think you get a nice 20, 30 point move at least down when it comes to its senses. I think so. I might be wrong. I like silver long for short 1660. That's another great one. Oh, oil's bouncing. Look, 857 and bounce finally. You typed in Cliff instead of CBI. Oh, yeah, watch that. No, that's because I realized it wasn't going to be CBI because that's right. Nothing wrong with CBI. I love them. The things going to Chicago Bridge are at some point you think somebody's got to do some infrastructure spending in this country. And the other thing is that we're going to start, Trump's really into like trade restrictions. So we're going to put import duties on the on steel and things like that from other countries. So that'll be a big boost to Chicago. Not only that though, but they got the home field advantage. So I think that'll be good for them in the long run. What killed Chicago this year is that they got these the nuclear contracts have been a real problem for them because they were working with Westinghouse, and Westinghouse is like bankrupt. Oh, sorry, I'm out of water. Hang on, I'm here again. Okay. Okay, so anyway, so they had deals with Westinghouse, and Westinghouse went bust, and then this question, and now Westinghouse is bankrupt, and people who need the plants cleaned up look at suing Chicago Bridge for their involvement, and so on and so forth. It's a disaster. So once they get out of all that crap, they'll be in good shape. Mm-hmm. Oh, the beige book, I forgot about that. Well, I don't really have time to get into it now. Hopefully somebody summarized it. Let's find out. Any thoughts on AMD and Intel? I still like Intel. I never liked AMD. I'm not a fan of AMD. I know they've really come around and done a lot of good stuff with the Internet of Things. They went a different direction than Intel, and it was good for them. But they've been certainly rewarded for it, right? So I think the train has sailed on that one. Intel is more like a steady force of nature. Over the same time period, it's not really as much of a boom as AMD. I mean, AMD just had phenomenal gains from back here. Intel's channely, and they're just gonna keep grinding along and moving up. Right now, they're a little bit high for me. I wouldn't get in here, but if they come back down, I would play them and go forward. You know, AMD though, I wouldn't go long on AMD at this point. I think they're fully priced in. I think Intel's principal advantage is gone though. I think Moore's law has finally run its course, and unless and I think unfortunately the future might belong to IBM. I mean, look, AMD doesn't make any money. I mean, that's crazy. Quarterly? They make money quarterly? They make a little bit of money. I would not. There's no way I would want to jump in on this thing. Because where are they going to go? It's not like no one's ever heard of AMD. They've been around forever. They're always the other chip company. They don't make money. They've had enough time to figure out how to make money. They don't make money. It's another one of these freaking sales with no profit kind of things. I don't like that. Not for $10 billion. Freaking Intel makes money. So if you're going to own... all right. I get angry about this stuff. All right, look. Intel, $200 billion. That's not the point. Intel makes $10 billion. Okay? When push comes to shove, they make $10 billion. That's 20 times their earnings at $200 billion. I don't, again, I said it's not attractive. I would rather wait for them to come lower in the channel, because lower in the channel is, this is 10%, this is 20% lower. So 20% lower, the PE drops from 20 to 16. I certainly like Intel making $11 million a year with a PE of 16 as a long-term part of my portfolio. But what the frick am I buying AMD for, who makes no money? What are they doing? You know, when they, and I liked AMD. I recommended AMD when it was like $2 because that was stupidly cheap. I mean, you know, because, well, the main virtue AMD has when it's down here $2 is that Intel can't let them die, because then if Intel lets them die, they're a monopoly. So Intel has to like ease off the gas and let AMD capture a few clients when they get too cheap, because Intel doesn't want AMD to die. Otherwise, everyone's going to point to Intel and say, "Oh, you're a chip monopoly. You got to break up." Intel needs AMD to point to and say, "No, we have a big competitor right there." But think about it, okay? It's a $200 billion company compared to a $10 billion company. The $10 billion company doesn't make any money. They only live by the grace of Intel, who needs them around, so they can pretend that they aren't selling almost every single chip in the world. So, you know, my point is, I don't understand why people want to play with things like this. When you have another company that's so clearly superior, it's like Barrick Gold. Like, what about this gold company? What about this gold company? No, ABX. Barrick Gold pulls gold out of the ground for less than $800. The industry standard is closer to $1,000, like $950 at least. They pull gold out of the ground for $800. Why? The management's long-term focus on the best producing mines, the most cost-effective mines. They buy mines, they'll buy out a competitor who's going bankrupt, and they'll analyze every mine, and they'll sell off all the mines except for the cheapest one to operate. That's what they do, and they do it over and over and over again, and every year they lower and lower and lower their cost of production. And it's so much to their advantage, because what happens is every time gold goes down and a few miners go out of business, they walk over and it's time for them to buy. And then when gold goes back up, they sell their mines off to other people who think they're going to make money, the mines they don't want, and then they wait for the correction and they buy them back again cheap. They wouldn't buy the same mines. They always want to buy the mines that operate cheaper or the most effective, because any miner's got a mix of mines. You know, there's some gold mines that have a high yield, some have a low yield, some have difficulties of transportation, construction. There's all kinds of issues. Labor is an issue. There's a lot of factors that make gold expensive or cheap to pull out of the ground. Well, environmental things, eventually you have to pay off, all kinds of stuff. Barrick is the best by miles at lowering all of those costs. So why would I give my money to any other gold miner if they're not better than Barrick? Now, Barrick, I don't know how we go on this topic, but Barrick, well, they're cheap, that's why. It's worth looking at. Barrick has 100 million ounces of gold. They had 140 million ounces of gold. They sold 40 million ounces of gold. Not, as such, but in the ground gold. The whole 100 million ounces of gold at 1,300 an ounce, is it now? Metal? At 1,300 an ounce is $130 billion. That's how much gold Barrick has proven reserves. You can buy the entire company for $16 billion. So for about 10% of the value of their gold, you can buy the whole company. Now, it costs money to pull the gold out of the ground, so the real value of Barrick is the net of the price of gold, $1,300, to what it costs them to pull it out of the ground, less than $900. So there's a $400 spread there. So 400 times 100 million is $40 billion. That is the effective value of Barrick. But that's over time, because they can't pull it all out of the ground tomorrow, even if they want to. But the bottom line is this company will produce $40 billion worth of profit on gold at this current price. Now, the price of gold goes up $100, all of a sudden their spread of the value goes from $40 billion to $50 billion. So gold only has to go up 10%, and Barrick is worth 20% more at least. So if gold goes up 20%, Barrick's worth 40% more. So you're going to get way better leverage on Barrick than you will on gold. So you're much better off owning Barrick than owning gold. It'll go up with a much higher percentage to gold, and because of their low-cost production, they've got a floor that gold doesn't have. So even if gold drops to $800 an ounce, which would be a devastating loss to you at $1,300, Barrick would still be operating at about a break even, and maybe they drop to $7, but the fact is the company's still there, still in business, and still could be, can become profitable again. You have a chance to double up or whatever. Plus, if you use option strategies the way we do, you're going to have a good, comfortable hedge on the thing anyway. You probably sell some short call. So that helps you make money even if it goes down. So that's why I like Barrick. But that's what I'm talking about, industry leaders. You want to invest in industry leaders. If you like a sector, who's the best in the sector? Not who's exciting in the sector. Who is the best? Like Merck or Pfizer. They're not sexy, but they're always, they just buy anything. Anything is hot, they'll buy it. I don't know what Pfizer is right now, but when they're cheap, you buy it. Not when they're expensive, you buy it, but when they're, like when Pfizer's 30, we buy it. When Pfizer's 35, we sell it because that's their track. But with options, as I pointed out with the ones earlier, I don't give a crap if it only goes from 30 to 32 because I can set up an option spread that's going to make me 1,000% at 32. So it's more important to me to find a stock that won't go below a certain price, because my danger in the way I set up these spreads is that it's going to go below my short put price, and then I'm liable for the difference. So if I sell the $30 puts in Pfizer, not now because it's 36, but if it was down around 30 and I sold the $30 puts, I am very comfortable that Pfizer is not likely to go below 27. I mean, here's for a few years. 27 is really, really cheap for Pfizer. Very unlikely they go below that. And it's such a big, steady business. That's more valuable to me than a stock that's going to double. I don't give a crap if they double. I care that they don't go below my risk price. But if I feel good about that and I can sell the $30 puts to $3, then effectively that money is free to me. So I don't mind promising to buy 2,000 shares of Pfizer for $30, which is $60,000, because my risk isn't $60,000. My risk is is $3 times $2,000, $6,000. That's what I'm risking. At worst, if I lost $12,000, I'd be shocked. So I'm risking, in a massive, massive pullback, I'm risking $12,000, and then my penalty is only buy the dirt cheap for the long run. That's fine. That's not risking. So that's the basis of my spread, and then from that, I'm going to make my bullish assumption with a bull call spread that it hits a certain strike in 2 years or 1 year or whatever my time frame is. But my return on cash that way is hundreds of percentage. And Pfizer doesn't have to go up a penny. That's the way you invest comfortably. That's the way you can make a fortune in these options. I don't have to chase momentum stocks. I just want to pick good stocks that are worth keeping, and my worst case scenario is owning a blue chip for a cheap price. Everybody, I understand that all the training you get in stocks is about like what's hot and what's going to go up and what's going to make the best return and blah blah blah, and it's exactly the wrong way to look at this kind of trading, which is value investing, because it's not. See, we're value investors because we find a stock that has value and we invest in it for the long term, but we're using options to leverage the upside so that we don't have to have a stock be a high performer. A steady performer is fine for us. A stock that goes completely flat is fine for us. So it allows us to make better bets, bigger bets, with better leverage, and profit from a market. And the market doesn't have to go up the way this market goes up. And as much as this market has gone up in the last couple of years, we're still blowing the doors off the performance of the S&P with our portfolio, without taking crazy chances, without chasing momentum stocks, and hedged up the ass also. We have huge amounts of hedges in case the thing goes bad on it. Yeah, remind me. Let me know how that Costco works out. We'll talk about it as it goes along. What do you think of adding ETFs to your 401k? Well, yeah. I mean, why not? You got to watch your cost basis on the ETFs, because even if it's 1%, like if the ETF has got a 1% cost basis, or 0.5%, let's say, that means over 10 years it's taking 10% of your money. I'm sorry, 20 years. So you talk about a 401k. Do you want to give them 10% of your money just for running an ETF? My general objection to ETFs is, let's say, for example, we look at what's the gold miners ETF? GDX? Is that right? Gold miners, yes. So having talked about Barrick, so here's the gold miners ETF, and let's look at what it says. Yield, 0.24%, annual expense ratio. Okay, 0.5%. So they're costing you face value. They're taking 0.5% of your money, but also because ETFs trade a lot, they're also costing you in transaction costs because they're constantly buying and selling the stocks that are in their portfolio. So aside from the fact that it's costing you 0.5%, it's as if you're every single day trading in and out of your stock. And the friction cost of that can get really excessive also. So their year-to-date return is 7.4%. Now, look at the holdings of these guys. And who do they hold? Newmont, they're okay. Barrick, Franco-Nevada, Newcrest, Goldcorp, they're okay. Agnico Eagle, Wheaton Precious Metals, my stock of the year, so there's nothing wrong with that. Rango Resources, Royal Gold, Kinross Gold, they're not terrible, but why do I want the dog? I can set up an ETF. Just look at the ETF that you want to get into. Look at what their best stocks are. You decide which ones you want to have, and buy three or four and spread the money around in it. That way you pay no fees. You don't have the turnover cost. It's not going to start eroding on you. You don't have to worry about what kind of wacky stuff they end up getting in their portfolio. That's all an ETF is. It's a bunch of stocks. It's not really beneficial. It's not better for you than that. And again, if you look at, all right, so GDX of the year is up 7%. So let's look at so my favorite gold miners are Barrick, which we just talked about. Barrick Gold, for the year, they have done nothing. So the index is doing better than Barrick for this year. I like Harmony, HMY. So if I'm going to speculate, I like Harmony, the South African gold miner. Also going nowhere this year. And I like Northern. This is a real speculation. Northern Dynasty. They own the rights to a huge mine in Alaska. And for years they were held up by environmental things. And now Trump is getting rid of all the environmental stuff. So, now the question is whether or not it's actually going to be profitable to mine the place. But now the environmental impact stuff is out of the way. So now it's going to be about whether or not it's actually profitable. But they have the potential to really take off. Now, we were buying them down here. So, it's kind of crazy now. I mean, now it's $1.92. We sold, we got out of most of ours already. We still have some because it's so profitable. But we're in it for like 20. We're in for like $10 to $20 range, not for this. So we were buying a lot down here. When it went up, we sold some. When it went up here, we sold most of it. And now we've got some left over here. But the basis is still way down here. But I like these guys. I still think they can do some huge numbers, but I can't get into like saying anybody should buy it when it's $2 and we have it for 40 cents. That's crazy. But anyway, you can cherry pick stocks. You can look at the ones that you want to be in. HMY. Oh no, not Holland. Sorry. Gold Corp is another one they have. I don't know how their fund is up 7% with everything they got in the fund is down. New fund. That's weird. I guess those little ones are probably doing good, the ones I don't like. No, Newmont's not going anywhere. None of these things are going anywhere. I don't see how they're up 7% for the year. That's weird. But anyway, right, that doesn't matter. But the point is, you just pick out the ones you like in an ETF, and you go with those. You don't have to have all the junk. Just go with the good ones. And again, because you're doing that, you can individually hedge, like with Barrick. And again, I cannot emphasize enough how great they are at this price. But with Barrick, we'll go back to the option concept. Right. So the stock is now 14. I can sell the $13 put for $1.75. That would net me in for $11.25. So a substantial discount. And I can pick up the $13 calls for $3.20, $3.30, $3.25, and I can sell the 20s for $1.20. So that's net $2. So I'm sorry, it's not net $2. It's net $0 because as I sell these puts for $2, I buy the 13.20 bull call spread for $2. So my net on the thing is $0. My worst case scenario, I'm assigned ABX at 13. So I get $1 off. That's the worst thing that can happen to me is I own ABX for $13, which I love to do. Best thing that happens to me is they go to 20 and I make $7. And what's my risk? My risk is owning Barrick Gold for 13. It's not a big risk. So would I rather do that, or would I rather invest in a basket of miners? I'd rather do this. Even if you're in a 401k and you got to pay the full margin. My margin is going to be $13 on the spread. I pay no cash, so I have 13 in margin tied up to make. At $20, I would make $7, which is 50% in 2 years. point is, I have very little downside risk. So as long as I have little downside risk and I have upside like that, it's a good play. You also have to factor in what their average price is. Yeah, well, that means a lot of stuff you have to factor in. Merck, please advise on a put sale. Merck? First of all, let's see if Merck is in a place where we want to sell puts. So I like somebody doesn't mean I will buy them now. But again, it's very simple to know if I'm going to like something. Usually you look at the channel and say, all right, they took a big hit. I don't know why. I haven't been following Merck closely, so I'd want to know why they took a big hit like this. Is it justified? Did something happen I don't know about? I mean, obviously something happened I don't know about. I assume this was earnings and they were disappointing. But wow, that's some pretty severe punishment for them. I always like Pfizer better than Merck. Let's make sure you guys know that. I just mentioned Merck because it's like Merck and Pfizer are always neck and neck more or less. Don't know why they went down that hard, but this is probably a good time to sell it. So let's assume that you did your due diligence and you know why they went down and you still think they're a good deal. Boy, I have to cut this thing off now. 2 hours. I can do 2 hours. Merck. No. So now you go, and now I say, well, what would I be willing to pay for Merck? And so if I say, well, I don't mind paying $50, another 10% down from here, I can sell the $50 puts for $4.30. But I can sell the 47.50s for $4. So for $3.90. No, you can't. No, it's $3.80, $3.25, let's say $3.50. So the thing is, if I can sell this for $4.30 and this for $3.50, for 80 cents, do I want to have $2.50 more cushion? That's what you have to ask yourself. I think I would, because I think it basically, to me, 47.50. I can't imagine they did something so horrible that they're down to 47.50. So I feel really safe about that, and that means I can then set up an aggressive spread. And so you can collect $3 on here and consider it $3.50. You can collect $3.50 there and consider it basically free money. And you say, well, what do I want to do with my free money? Well, if these guys are all right, let's be aggressive. So $6.75 for the 52.50s, and I've got $3.50 to spend. So therefore, I'm going to look for something that's about $2.75. So I'm going to sell the 62.50. So I could have the 52.50, 62.50 spread, $10 spread, and that's going to cost. This spread is at least $2.50, and 6.75 is 4.25. So basically, it would cost me 75 cents to be in that spread, and that spread is $2.50 in the money now, and I'm paying 75 cents for it. So again, I can only lose 75 cents all the way down to 47.50, at which point I'd have to own Merck for net 47.50 plus 75, which is 48.25. So my worst case is owning it for 48.25. And then if they recover back to 62.50, I'm going to make $9.25 on the spread. So, that's the way you want to play something like this, because, your upside is ridiculous. The return on cash is astounding. And the margin's not much anyway. If you sell the 47.50s because they're so out of the money, so let's say we sell 10 of them, and we say 350. So if we sell them for 350, it's only $3,000 of your buying power. So, that's a really, really efficient way to trade into a stock. And it's very important, though. You don't want to get in trouble with margin and leverage and stuff like that. The idea is not to say, oh, it's only 3,000, so I can do 10 times as much. No. You do the little amount. It only costs 3,000. You leave yourself with tons of buying power and tons of margin, so that if it happens that it goes down, you can make an adjustment. Because when you invest this tiny little bit of money and you can make a 1,000% return in 2 years, you don't need to put it all on the line. If you can make a steady 20% or more with low risk, that's the most valuable thing in the world. Warren Buffett only made 16% average, but he made it for 50 years, and that's how you become a billionaire. 16% for 50 years gives you $1 billion, gives you $100 billion in Buffett's case, and that's all he does. He just takes the money, makes 16%, makes another 16%, another 16%, and it compounds and compounds and compounds, and all of a sudden he's a billionaire. And you can do the same thing if you just steadily make your money and don't. And Warren Buffett has one rule in investing: don't lose money. And that's the whole key to his success. I think in 50 years he's had like 3 or 4 years where he lost money. Out of 50 years, every other year, somewhere in the neighborhood of 16 to 20%. I mean, some are 5, some are 30, but whatever, you know. That's how you get rich. Very few people get really, really rich trading, swinging for the fences, you know, trying to get these big plays. The way to get rich in reality is steadily growing your wealth year after year after year consistently. And that's what our system is about. It's about turning your investments into consistent payers. And stop gambling. That's what we're trying to teach people. I got to wrap this up. SunPower is considered semiconductor stock, and he's still comfortable with SunPower at 7 in the OOP. Yes, it's still in the OOP, so I am. You know, look, it's not. I'm not excited about it, but I think it's good to have. I think solar is not going away, and I think this is a good floor. I mean, I don't know when and if it'll take off. There's a whole bunch of stuff going on. You know, the tariffs and everything else that's going on between China and the U.S. and then Europe is cutting back on their solar and Trump obviously has dumped solar completely. So you think there's a lot going against it, but what's going forward is the cost of solar. It is now the cheapest way to produce electricity. Cheaper than coal, it's cheaper than natural gas. Solar is the cheapest way to produce electricity. The only problem is there's the initial cost outlay. But once you get over that, it's cheaper. You know, it's cheaper to set up a natural gas or a coal turbine plant and feed it as you need the electricity and make a profit between what you spent and what you're buying the raw materials for and what you're outputting. That's your profit. So instant cash flow. If you do solar, you've got to lay out a huge amount of money, and then over 10 or 15 years, you'll collect it back, and then after that, it's profit. But that's not as attractive as a business model. So when the government pull back and don't give you the aid, you tend to get a hiccup in development. But over time, it doesn't matter because other financing will step in and make it, and make it work. All right, so let's see. So long term, I love solar. So even if it doesn't go up now, I'm still happy to be in it for the long term. A short sale on GSK. I mean, if they're cheap, I like them. They're a decent company. They're not one of the ones we play. You know, it's very cyclical, these farmers. So when they are down, it's the time to go. Yes, now would be the time to do something like that for sure. All right, sorry to cut it short, but I got to run. Do you have any open positions on TF or SI? I still have some TF short. But I'm just letting those ride. I'm just going to see what happens over time. Thanks a lot, Merck. Okay, cool. And get well. Yeah, I'm fine. It's a little cold. It's annoying. All right, guys. Well, we're over time. We can't do that because we can't have too long of a recording on these thingies. Thank you, everybody, for coming. I hope you enjoyed it, and we will do it again next week, all right? Hopefully without the cold. Take care, folks.